In this COVID-19 era, many Ghanaians have seen the need for a financial fallback plan. If you're looking to improve your financial situation or need reliable information to make sound financial decisions, join the Access Money Show, a weekly interactive session hosted by Access Pension Trust. On Access Money, we feature industry experts to cover various personal finance topics and share the success stories of sound investment decisions. Access Money, Wednesdays at 9:30 a.m. on Sunny FM. Access Pension Trust, a reliable partner in pensions.
Hello everyone, welcome to the Access Money Show. It's an interactive session where we talk about personal finance and retirement planning related topics. This program is proudly brought to you by Access Pension Trust, a leading private pension provider. My name is Anane-Appiah and I'll be your host. Today we are talking about investing in government securities, and we have with us no other than Mr. Isaac Opare. He is a deputy head of client relations with us here at Access Pension Trust. But before we continue this very exciting conversation, let's take a quick word from our sponsors. The beginning of the new year presents an opportunity for you to assess and review your retirement plan. Will your projected retirement benefits be enough to meet your desired retirement lifestyle? There's a lot you can do this year to improve your retirement prospect. Here are some of the tips you can consider. Review your retirement fund statement. If you should maintain the same retirement savings strategy, will you be able to achieve your retirement income goals? Take advantage of the Tier 3 Provident Fund and the personal pension scheme. The Tier 3 is a tax-efficient way of saving for your retirement. Avoid withdrawing from your pension funds prematurely, as you might miss out on long-term benefits of compound interest of your funds. Pension advisors are available at Access to guide you to improve your retirement prospects. Visit our website to learn more. Access Pension Trust, your reliable partner in pension.
Auntie Mary, give me fufu 10 cedis, Willie 6 cedis, goat's meat, apapo 12 cedis, and chicken thighs, fat one 8 cedis.
Okay, right away.
Sauce kaleke, payday is good. Add beer 1 wine.
In the hustle and bustle of life, retirement considerations
Next year
are often relegated to the bottom of our collective financial agenda until retirement hits you unprepared. Living on a meager retirement income can be traumatic and stressful, as you can no longer afford to live life the way you want.
Can I have fufu 50 pesos, goat's meat 1 cedi, and chicken thighs small 50 pesos?
Hey, please, we don't sell adunle and achomo here. Go to the next store.
Hey, adu yawao.
Welcome back. Remember that this program is proudly brought to you by Access Pension Trust, your reliable partner in pensions. From the beginning of the year, we've been talking about the need to work towards wealth creation. But what investment vehicles do you use? We want to spend the next few weeks talking about the various options available, and want to start this series with government securities. As I said, we have with us here the amazing Isaac Opare to do justice to this topic. Welcome.
Thank you, Mimi. Thank you for having me.
So today we are talking about government securities. What are government securities?
Okay, government securities are debt securities. When you say debt security, you give money to someone in simple terms, and then at an agreed time, the person pays you back. Now, government borrows money to finance its activities. It's one of the main sources of funds for the government. When it comes to government securities, the simplest explanation of it is that the government comes to the public, it issues a paper, a document, and that's what is called a security. You give money to the government, and in return, the government gives you that security. Then at an agreed time, you get a return, an interest, a benefit on it for the period within which you gave your money to the government.
So can you give us some examples of government securities?
Thank you. So a few examples, there's treasury bill, treasury note, and then treasury bonds. Now, if you look at, they all begin with treasury, meaning that it comes from the government. Treasury bill usually mature within a year, Treasury notes between a year and less than 10 years, and Treasury bond between from 10 years onwards.
Okay, but in Ghana, you sort of hear some 3-year, 5-year being called bonds.
Sure.
Yes.
Well, in finance terms, that is a wrong way of explaining it. Ideally, every government security that matures between more than a year, or if you want 365 days, and then less than 10 years is called a treasury note. Sure.
Okay. So how do these government securities work? Okay. I know apart from the tenure, they sort of have some similarities. Sure. How do they work? Okay.
For treasury bill, there are, if you go into detail, there are about 3 of them in Ghana specifically. They're the 91 day, 182 days, and the rest. So you pay an amount of money mostly at a discount, meaning that if you are going to give the government 100 Ghana cedis, and then the interest on it is say 10% per annum, assuming per annum. Now you'd give the government say 90 cedis. Then at maturity you receive 100 Ghana cedis, which means that the 10 cedi difference is the returns you received on the treasury bill. That's how treasury bills work. Okay. Then the treasury notes, beyond the note and then the bonds, they pay coupons, or if you want interest, periodic interest, mostly twice in a year. So for the treasury notes, you give government an amount, then every 6 months you receive a rate based on the you receive a return based on the rate that you bought the security for. Okay. It works like that for bonds as well.
Okay. So with the bills, is the difference between how much you bought it and how much you're paying that becomes the rate. Okay. Sure. Okay. What are some common mistakes people make when buying government securities? Because I know treasury bill is like the most popular investment. Bonds are becoming popular these days. Sure. You hear more people asking about bonds. Sure. But I'm sure there are mistakes people make that may prevent them from benefiting from these investments. Can you touch on those?
Okay, I want to give a scenario, and from that scenario, I'll cite examples. Okay. Assuming you want to take a trip to Takrady, and for that trip, you have possible options. One option is to fly, use an airplane. Then another option is to use a car. Now, you don't like flying, or you're scared of height and things, so you don't want to do airplane. You want to go by road. In going by road, you could sit in a truck. You could sit in a V8. So buying a government security, because all over the world they are considered the most safest, that can be likened to going by road. Now, you go by road and you want to do government securities because they are more like the most safest. So you want to go with a truck because it doesn't speed too much, it takes its time, it's big and things like that. But you make a mistake if you only stick to that and you're not open-minded, because there could be a V8 which you pay the same cost for the two, but you don't enjoy the ride that much. What I mean is that even though government securities, people buy them with the hope that they are the most safest, there are other investments like government securities, or that prices on or benchmark government securities to set their prices, which you could benefit more on it. In simple terms, government borrows from us. For example, T-bill. When government is giving you that money, say at 20% per annum, if another financial institution wants to give you the money, they have to give more than what the government is giving. So in the example I gave where the government is giving or borrowing at 20% from the public, if another financial institution would have to borrow beyond the 20%, or at say 21, 22, 23. So people most of the time forfeit the benefits of investing in similar instruments that are like the government that could have paid more. Another reason is that some people also don't consider inflation. Inflation is very important when you think about investing, because the benefit of investment can be eroded by inflation. A typical example is the nice dress you are wearing. Assuming you saw the dress today and it's 200 cedis. You have 200 cedis, you want to buy it today. You're like, I watched Smart Money Talk and I was told to invest. So let me invest that money so that I'll buy the dress in a year time. In a year time, the price of the dress has grown from 200 cedis to 210. and your investment has grown from 200 cedis to 220, that case you make a profit. I believe you get it. On the other way around, if inflation is more than the returns, then you are losing out. And people don't look at inflation so much. So anytime you want to invest, even not just for government securities, you should look at inflation so that you look beyond, or you look at getting more than what inflation rate is. Government securities, most of the time, can be more, but you have to be very mindful of inflation and look at all the other options to make a good decision for yourself, so that at the end of the period, when you receive your money, you'll be able to buy what you forfeited or what you decided not to buy. The other one, I mentioned it in passing, will be the opportunity cost, because people buy government securities with the belief that it is the safest. There are other equally safe investment vehicles that are on the market that people can take advantage of course, in addition to buying government or Ghana securities. An example is the Access Pension Plan, and it gives you that broader benefits, because as an institutional investor, Access could get higher returns for when it buys government investment than maybe me as Isaac, who wants to buy a government security.
Okay. I want to also ask about, maybe I buy a 91-day treasury bill with the purposes of going to school.
Okay.
But I'm going to school in the next 2 months,
Sure.
not in 91 days.
Exactly.
What happens?
Okay. Now, what will happen is that you would, after 2 months, you want your money. So you're going to go to the financial institution where you bought the treasury bill or whatever, treasury bill, yes. And you need your money. Because the maturity period isn't due, you would get it at a discount. In other words, in simple terms, you will lose some money. And so in that regard, people should also be mindful of how long they want to keep that particular money before they buy it. There may be other money market investment or instruments that you can buy, and within a month you can walk out of it, as in it's very liquid. Unlike the government securities that are mostly less liquid than other investment on the market. So in the example you gave,
the period.
Yes, fixed period.
The period.
Sure. So in the example you gave, T-bill is a fixed income, which means that if you are going to hold the security for less than the period, you lose out on the money, the returns.
Let's talk about the bonds too and the notes. So you mentioned that there are coupon payments that mostly come in, for most bonds would come in every 6 months.
Exactly.
You know, we have mentioned compound interest in the past. These are contributions, or let me say returns, that you receive in your account.
Exactly.
And a lot of us would end up spending it on one thing or the other. How is it likely to affect your goal in the long term?
Okay. Now, for someone who wants to grow their money, one of the biggest instruments to take advantage of is compound interest, which we've talked about so much on this show and every other platform. Now, if you buy a bond and the goal is to grow the money, you might lose out on compound interest, especially if you don't reinvest the coupon, because anytime you get that money has a way of telling you what to do with it. Yeah. It's not witches, it is how money is. So before you realize, you are spending that return, which is like your chicken laying an egg, and instead of pre-hatching that egg, you take it and eat it. So you lose out on compound interest, as in the fact that you would have had the opportunity to recompound the money. Another way is that if you are getting coupon every 6 months, you are losing out, because for typical investment like the Access Pension Plan, the compounding is done in short intervals, sometimes daily. So it means that if you had 100 cedis today, it goes into investment. The next day, you receive an interest on it. That interest also goes into investment. So it's more like you're rolling over frequently. But in the case of a bond, even if you decide to roll over or reinvest the coupon, you're doing that at 6-month interval. And that's also another big disadvantage for people who would buy a bond vis-a-vis buying other investment that take advantage of compound interest.
Yeah, taking into consideration the interest rate, especially if they are
at par.
Yes. Very insightful. Let's take a quick break to hear from our sponsors, and when we get back, we'll continue with how much you are likely to earn and what the likely risks are when you invest in government securities. The beginning of the new year presents an opportunity for you to assess and review your retirement plan. Will your projected retirement benefits be enough to meet your desired retirement lifestyle? There's a lot you can do this year to improve your retirement prospect. Here are some of the tips you can consider. Review your retirement fund statement. If you should maintain the same retirement savings strategy, will you be able to achieve your retirement income goals? Take advantage of the Tier 3 Provident Fund and the Personal Pension Scheme. The Tier 3 is a tax-efficient way of saving for your retirement. Avoid withdrawing from your pension funds prematurely, as you might miss out on long-term benefits of compound interest of your funds. Pension advisors are available at Axis to guide you to improve your retirement prospects. Visit our website to learn more. Axis Pension Trust, your reliable partner in pension.
Auntie Mary, give me fufu 10 cedis, wele 6 cedis, goat's meat, apapo 12 cedis, and chicken thighs, fat one 8 cedis.
Okay, right away.
Sauce kaleke, payday is good. Add beer 1 wine.
In the hustle and bustle of life, retirement considerations
Next year.
are often relegated to the bottom of our collective financial agenda until retirement hits you unprepared. Living on a meager retirement income can be traumatic and stressful, as you can no longer afford to live life the way you want.
Can I have fufu 50 pesos, goat's meat 1 cedi, and chicken thighs small 50 pesos?
Hey, please, we don't sell adunle and achomo here. Oh. Go to the next store.
Hey, adu yawao.
Welcome back. Remember that this program is proudly brought to you by Axis Pension Trust, your reliable partner in pensions. Before the break, we were talking about government securities, what they are, how they work, and common mistakes people make when it comes to government securities. And we had Mr. Opare doing justice to the topic. Opare, what are the likely returns that you can earn on a government security? And as you talk about the returns, let's also talk about the associated risks.
Okay, sure, thank you. So when it comes to government securities, the return that you would get are basically coupons for the note and then the bonds, and then for the treasury notes, the treasury bills as well, the interest you will get on the money you put in. But to even drive a bit deeper, when you compare it to other variable incomes like shares and the rest, the returns you will get on your money or your investments is mostly variable. It could be very high, it could be very low, you could actually do negative. But the thing about government securities is that you get a fixed return. So you know when you put 100 cedis or you lend the government 100 cedis and the rate is say 10%, you're going to get 10% of that 100 cedis depending on the period. And then when it comes to the equity bets, it's not that straightforward. Well, somebody could say that in the equity bet you could even get capital appreciation, you could get dividends, but this one is fixed, just the returns you are getting on it. In terms of the associated risk, government securities are considered the least riskier because the government is considered the safest borrower all over the world. So bottom line, it's considered the most safest if you should rank any group of assets. It is very, very unlikely that the government will default and not be able to pay. In time past, the only time we've seen that, or the only country, has been Greece, where at a point they were not able to pay. And so given that it's very, very, very unlikely, even in historical past, it's considered one of the least risky investments.
Interesting. And so those who are highly conservative can look at T-bills as an option, so sure. Government securities like bonds. I know bonds are for a longer period to have more risk than the T-bills.
Sure.
Would you touch a bit on that?
Okay, it does very well because most of the time, like I mentioned, inflation is something that you should always be mindful of. So even beyond the risk where a government might default, there's also the inflation risk where you buy a bond for, say, 19%. Assuming last year you bought a bond for 19%. Currently, inflation rate is around 29% or so. That's a loss there. So that's a very risk you don't want to put yourself in. We remember, I think about 5-6 years ago, interest bond rates and T-bill rates were around 24-23%. Somewhere about 3 years ago, 4 years ago, it started going down a little bit. And recently we've seen a rise in response to inflation. Of course, demand and supply playing a very, very key role in there. So when you hold short-dated securities, you are less likely to be affected by inflation because often within 3 months, the 3 months, that's the 91-day or the 181 days, 182, sorry, you're able to get your money back. But for long-dated, inflation might just take away all your returns.
Okay, interesting. So what are the ways we can invest in government securities?
Okay, so first off, government securities are sold to the market through auction. But as an individual in Ghana, you cannot buy directly at the auction. There are financial institutions, mostly the banks and other financial institutions, that can buy at those auctions. Then they then sell to the public through the primary market. So like in the example we gave at the beginning, Mimi has some 200 Ghana cedis. She doesn't want to buy this dress. She can walk to a bank and put that money or buy treasury bill with the money. That's a direct way to do it, even though you are not buying it from the government, which would have been at auction, but you can do that directly. The other indirect way is to buy through an institutional fund, like the Active Pension Plan or any of the other money market funds on the market. They buy such funds, so you can, by buying their funds indirectly, you're also buying government securities because they in turn buy from the government such securities. And then the benefits or the returns are shared for all members of that collective investment. And you, the member who bought that, indirectly you've benefited or you've invested or you've given money to the government as a loan.
Okay, so when would you tell someone to buy directly and when would you advise someone to buy indirectly?
Okay, now for somebody who is so certain that they are going to hold the money or the security for the period the security is going to last, they can, or somebody who wants to go the least riskiest way. So somebody who is a risk averse, like he doesn't want to take any risk at all, and he or she is sure that he can hold the money for that period, it will be okay to buy the government security directly. Like, because you know that if you don't hold it to maturity, you will lose some funds. But for someone who wants to get a little more than what the government is giving, for somebody who wants a fund that is a little liquid, in that if you need the money, you can go in there and buy and take the money without losing any funds, then you can look for a fund that allows you to withdraw within that period that you are looking at. And I've mentioned Active Pension Plan already. Of course, there are other good investments on the market that also take advantage, or that can help you take advantage of this as well.
And I know that with T-bills now, you can buy it with smaller amounts than usual. But if you also had something small, you weren't too confident to, when saying, I'm buying T-bill 50 cedis, maybe the indirect.
Exactly. So imagine walking to a bank, any bank that you're thinking about, you think about it, and then going there with 50 Ghana cedis, 100 Ghana cedis, and what are you coming to do? You're coming to buy a treasury bill. Somebody might not feel very confident about it, but with most of these investments, with some of them as little as 10 Ghana cedis, you can invest there, and as and when you get it. You can't be going to the bank maybe every day to buy a treasury bill. You might not be confident to do that, but through other institutional funds, you get to do that and take advantage of government securities.
So, Opare, what are the benefits of buying government securities?
Okay, so I'll talk about two. One of them has been an underlying theme during the discussion, the fact that they are considered the safest in the market everywhere in the world, because government is seen as more like the biggest lender or the biggest businessman in the country or in every country. So they are considered safe. That's the first benefit. The second benefit is in two ways, and it will favor you depending on which point of purchase it is. Whenever bond or government security rates are high and you buy them, you get to lock in the rate, especially if it is a fixed rate security. Some securities are not fixed, meaning that depending on happenings in the economy, they can be varied. But in areas where they are fixed, and say you buy a bond at say 29%, 31%, next year, next 2 years, government securities could be selling at 10%, 19%. You are not bothered too much because you've locked in your investment at a good interest rate, and it is very, very unlikely that government will make an attempt to review the rate or to default. It's very, very unlikely. So when that happens, it's a benefit. You've locked in your funds and it's earning some good interest for you. Now the other side is when the tables are turned. So you bought the security when interest rates were low, and now interest rates are high, but it's also a long-dated bond. Your option would be to discount. In other words, you have to end the bond, terminate it, and you lose some funds before you can now buy the new bond, which is being issued at a higher rate. So as a benefit, you get to lock in the investment if it's long dated and at times when the interest rates are good, so that even when rates fall, you become unperturbed.
Great. So let's talk about who should invest in government securities.
Okay. Who should invest in government securities? For people that are, we've mentioned that in person, people that are very risk averse, they don't want to take risk when it comes to their money. For people that, there are some people also who have a way they look at their money. Say they have 100,000 Ghana cedis. They want to invest that money and only take their returns periodically. So that's also more like in every 3 months, depending on the maturity of the bond. So if you are somebody, say, on retirement and you want to go the least riskier method or way, then of course you can buy treasury note, whichever one fits your purpose for holding that security. Then if it's, for example, a 91-day treasury bill, it means that every 3 months you get to take the returns or the interest and then use that while the principal grows for you. But mind you, with time, because of inflation, the principal is not going to be worth as much as it did at the beginning of the investment. But of course, if that works for you, fine, you can do that. And for anyone who wants to grow their money, because we also talked about people who invest indirectly. If you invest in a fund that takes advantage of diversification, then of course through that you get to benefit from government securities and of course other investment vehicles as well, just by investing with one institutional fund who will do the work of doing the diversification. Just to bring something you mentioned, you have 100 Ghana cedis, you want to use say 10 cedis to buy bonds, 20 cedis to buy shares, nobody will listen to you. But if you buy or if you invest into an institutional fund, they can use part of that to buy shares for you, part of that to buy government securities, part of that to do other investment for you with that little amount of money.
Yeah. Thank you so much for these tips. I trust that now you know that it's not just T-bills, there are treasury notes, we have treasury bonds, and all these are things that, investments that you can take advantage of it, both directly and indirectly. And like he said, if you find yourself wanting to have a stable stream of income, or you find yourself in a situation where you don't want to make any losses at all, maybe you can look into treasury securities. You can also look into doing them indirectly through mutual funds and pension funds. Thank you so much for joining us on the Access Money Show today. Remember that this program is proudly brought to you by Access Pension Trust, your reliable partner in pensions. Do join us every Wednesday at 9:30 a.m. on Sunny FM. Until then, you can get some of our tips on personal finance at our website at www.accesspension.com. www.accesspension.com. You can also reach us on 0302 738 555. 0302 738 555. Until next week, have a wonderful day.
In this COVID-19 era, many Ghanaians have seen the need for a financial fallback plan. If you're looking to improve your financial situation or need reliable information to make sound financial decisions, join the Access Money Show, a weekly interactive session hosted by Access Pension Trust. On Access Money, we feature industry experts to cover various personal finance topics and share the success stories of sound investment decisions. Access Money, Wednesdays at 9:30 a.m. on Sunny FM. Access Pension Trust, a reliable partner in pensions.